We are now coming to part 2 of this pre-scene analysis. So in part 1, we very clearly went through the introduction to the company, telling you your role. Then we spoke about the tea industry. And then we spoke about some of piping's background, some of piping's history, the culture of our business, the process of our business. So we stopped at the understanding the process of, just the processing method which was explained. And that is where we called an end to part 1. In part number 2, we are going to continue where we stopped on in part 1. But before we start part 2, it is very important for us to be clear with the information that is present in part 1. So whatever information, whatever discussions, whatever topic areas from E2, P2 and F2 we went through in part 1, those should be the areas that you have a clear idea and clear knowledge of. Be comfortable with that material. Be comfortable with the extra industry analysis that we have done with you. And then begin with part 2. Remember, the pre-scene is a very, very important document in your preparation. It is one document that you are going to use very many times, and you have to be comfortable with the material and with the basic knowledge of your company. And that is the whole reason why we do such a detailed pre-scene analysis. So keeping that in mind and knowing that I should know the details of my company so far, before I start with part 2, let me begin. So part 2 begins where part 1 ended. We are starting to speak about the process of making tea bags. So what is the process of making tea bags? Let's begin. First, the loose leaves required for each tea bag are placed on a strip of paper. This is just for me to know the processing method. They're not going to quiz you on how is a tea bag made. That's not going to be an exam question. But when I'm trying to understand the company, the processing method, the method of making a specific tea bag is something that I should know. So if they say in your exam that the tea bag processing line, something has gone wrong, so you're not blank. You know what the method is. You know how tea bags are made. So you'll be able to form your answer in a better way. So background knowledge is very important. So a second strip of paper goes on top of the two strips, and these are fused together around the tea leaves. So tea leaves in the middle, strip on the bottom, strip on the top. The fused strip is then cut to separate the individual tea bags. More expensive brands of tea bags, including pipings, have a tag attached to make it easier for customers to lift them out of their cups. They'll have a thread and a tag, so you can dip it again. So individual tea bags can also be packaged in a paper envelope to maintain freshness and to permit branding to be printed. Tea bags are then packed in foil, boxed, and placed in outer cardboard boxes for transportation. They're just telling you this is how a tea bag is made. Now, there are two separate production lines for loose tea and tea bags. So loose tea made on one line. Tea bags made on one line. We have two production lines. All of the processes are highly mechanized. Now this tells me that a highly mechanized process is important to maintain efficiency. I understand that because machines can give you an efficient way of producing. Modernization and further using automated machinery should be seen as the next step moving forward. Trying to remove as much as labor involvement should be seen as the way ahead, because that's what modern manufacturing methods are advocating. And because of this, your topics of leases, because they may tell you that we have leased a new packing machine or a processing machine, anything can come up. So how will it work? How will this lease be accounted for? So your leases from your F2 syllabus. They may tell you we need finance for this machine. How can we raise finance? So long-term finance, short-term finance comes into the picture. How will our cost of capital be affected if we take on this extra loan or if we raise equity? So your cost of capital topic from F2 also comes into the picture. So at every stage, we try to make sense of whatever we see in the pre-scene as important from the E2, P2 and F2 perspective. Next, they're clearly telling us that we have 700 production staff which are employed to monitor the operation of the machinery on the production lines, make adjustments, carry out preventive maintenance, and deal with breakdown. So these are staff that will be involved in the production process. You're a big company, 700 people working. The machinery undertakes almost all of the manufacturing and handling of the inventory. The next section that we look at is the marketing and distribution section. Now, piping's products are sold through most major retailers in Northlandia. We sell through retailers. So why are we not exploring other sales channels? There are huge opportunities because of this digital world. So major retailers has been one avenue of the sales. But why don't we look at a website where customers can come and order their tea of choice and get it delivered to their house? Secondly, we can have a application as well, a mobile application where people can choose the tea that they want on their phone itself and order it. So we sell through retailers. That's the conventional route. Supermarkets is the conventional route. We've spoken about this in our industry analysis that we've done. But in that industry analysis, we also learned that the online market was one which was growing. People are ready to look at online as a sales channel to order their preferred tea. So this could be something that we keep in mind because they say that we sell through major retailers right now. No other information is given on this page. The marketing and distribution department has two main functions. So two functions of the marketing and distribution department. The first is advertising. So piping invests heavily on advertising in order to maintain brand awareness. So to be able to be seen, whenever anybody thinks tea in Northlandia, they should think of piping. That's why they advertise. The company's brand name is one of the most recognizable in the country, but it remains important to advertise through traditional channels and online channels in order to prevent loss of market share. So it's very clear that your company has a brand name. It's been in the market for a very long time. So the company will have good internally generated goodwill, good standing in its local market. Remember, you're the market leader. You are one of the major players in the market. Advertising is also helping piping to develop brand loyalty from younger customers who want to switch to other drinks from coffee. So maybe they're having coffee right now, they want to switch to tea. So to attract those customers, your branding and your advertising is very important. The advertising team is part of piping's marketing and distribution department. It has a substantial budget for the development of new advertisements and for broadcasting the publication. So budget setting, budget management will be very important. They can ask you, budget related questions. So the different budget relation methods, what are the different ways of budgeting? What are the different styles of budgeting become a viable question. This is directly from your P2 syllabus. Because if you don't have an accurate budget, if you don't know what accurately the department is going to do, how will you assign them the money that they need to, attract customers? So that is something that we keep into mind. The second function of this marketing and distribution department is account management. So they deal with advertising plus they deal with account management. Piping is the largest tea manufacturer in Northlandia, and most food retailers wish to sell Piping's products. Piping strives to maintain a strong relationship with major retailers by having a designated account management team in its marketing and distribution department. So they want to be present and they want to have a good relation with supermarkets as well, retailers as well, because that's where majority of our tea is selling. So they're telling us that we want to maintain this relationship management, creating teams that effectively work with each other, that effectively deal with these accounts. So team management, conflict management, because wherever there is a team, there is a possibility of a conflict. So conflict management, understanding the level of conflict, all of this is important, and your E2 syllabus comes into the picture here. So this team's function is to engage with buyers employed by retailers. Typically, a major retail customer will be assigned an account manager who will be designated contact between piping and the retailer's buying department. Whenever they want to buy, they directly call this account manager who will deal with all the processes. So there is a one-time communication, there's a one-stop communication, avoids confusion. Account managers will also seek to encourage buyers to place regular orders, increasing their spend as much as possible. Because obviously, your job is to sell. For example, an account manager might be authorized to offer a discount in return for an increase in the retailer's regular order. Account managers also keep retailers informed about forthcoming promotions. If there are any promotions, new advertisement campaigns that may increase the demand, the account manager will call the retail manager and have a word. So it looks like the concept of responsibility accounting is being implemented here. That account manager is given responsibility, full responsibility for that particular retail customer. So all the decisions, the costs, as well as revenues could be the responsibility of this account manager for that specific account. So he's more accountable. You can better judge his performance. This is part of your P2 syllabus. So piping is employing techniques that are modern, but they need a little bit of, I'll say, further modernization. We'll speak about it as we go deeper into the pre-C. Now, account managers frequently visit supermarkets to check the placement of piping's products. Now, supermarket shelf space is always limited, and the extent and location of products on the shelves can have a significant impact on sales. If piping teas are somewhere at the back end in a corner somewhere, people are less likely to find it. If it's somewhere where they can easily see it, easily buy it from, and that is important for piping, because if it's not placed properly, it won't have the sales. If it doesn't have the sales, piping is getting affected. So these checks and visits are quite important. Piping's marketing and distribution department keeps close contact with consumers to ensure that their teas remain popular. Everything is about branding, advertising, being out there, so that there is, whenever anybody thinks tea in Northlandia, piping is what should come to mind. That is the thought process of your company here. The company makes several varieties of tea, each of which aims to attract its own specific niche of tea drinkers. So different varieties of tea are being made. Now over here, it's clearly telling me that because I'm making a different variety, different products, number of products, pricing them accurately will be key. If you don't know what the cost is, if you don't know what the price is, if you don't know what the input cost is, if you can't adjust your cost, how will you price the product well? So a robust costing system and track of the business spends would be key. A new and innovative costing method such as ABC could be looked at, could be looked upon, and is a favorite exam question. This brings in your P2 syllabus over here. For example, piping's strong flavor was developed 5 years ago because of the feedback from a sizable minority of customers who were using 2 tea bags to get the strength of the flavor that they wished. So piping saw this. They have a good external market analysis team. It's clearly showing this because they took the feedback. They saw this was something I need to improve upon, and they did it. Piping's tea blenders then developed a new blend that could deliver a stronger flavor from a single tea bag and so created a very new but popular product. So this showcases the external environment analysis and external market analysis that is done by our company. So we noticed the need in the market and developed a product to serve that niche. This can be seen as a competitive advantage about my business. My business is ready to do this. My business is ready to accept change, ready to look at the customers and see what they want. That is the major, I'll say, plus point of this global fast moving environment. Do what the customers want. Now, Piping's marketing and distribution department also has a small team of sales managers who seek to expand Piping's export sales. Although the company's brand image is strongly associated with Northlandia. So we have a small team that's looking at exports, and as we go deeper into the pre-scene, we'll see exports are a very small percentage of our total sales, but this has to be seen as the stepping stone. We already have a very strong name in Northlandia. Why not look at exports as a major opportunity? In our industry analysis, we've seen that there are lots of countries that have high growth rates for this popular tea market. There are nevertheless some other countries in which piping brands are popular. There are also several countries where retailers sell piping tea to meet the demand from local communities of Northlandian expatriates who enjoy drinking piping tea because it's reminding them of their home. So just to tell you that there are some export sales, a very small percentage, but increasing them has to be seen as the way forward. Next, we have social responsibility that we will be speaking about, a very important concept in this modern environment. Most tea plantations are located in developing countries, which has led to some controversy over the rates of pay and the working conditions imposed on these plantation workers. So, piping is in common with most tea manufacturers buying tea leaves from auctions, and so the company has very little direct contact with those actual plantations. They don't care about where which plantation it's grown in, they're going to buy it as a lot. The fact that prices are set at auction means that there is at least some transparency over the pricing. Now, piping supports a number of local charities and other initiatives in tree growing countries that are intended to encourage plantation owners to treat the workers fairly. Now, social responsibility, social concern, and just being an organization that looks at the environment, cares about the environment, cares about where its inputs come from, is seen as a very big competitive advantage in today's modern world. People are ready to pay a little bit extra for the product of a company that is more socially responsible, and piping is doing that. So they are trying to support local charities. They're trying to make sure that the plantation owners treat the workers fairly. And these initiatives also offer practical support, such as funding for their schools, medical facilities in tree growing regions, where government facilities are difficult to be available. Let's put it that way. So piping is doing little bit in its own capacity to be a company that cares about the external environment as well. So CSR and company image is very important in today's modern environment, as this can harm the company's reputation to the point of no return. If, for example, there is a newspaper article that says that piping is exploiting, is buying rather tea leaves at a very cheap price from plantations that are exploiting their workers, just imagine how much reputational damage that can cause to such a big company of yours. So, CSR, from the company's perspective, corporate social responsibility is very important, and because piping is doing its bit, can be seen as a competitive advantage. Piping's manufacturing process are designed to use resources efficiently and to minimize the waste. Its production lines are maintained regularly in order to reduce the amount of power required for their operation. Products are designed to eliminate waste. For example, all packaging is recyclable and uses as little material as possible to reduce the weight and to reduce transportation cost as well. So they're telling you what we are doing from the sustainability perspective. Pipings tea bags and loose tea leaves can be recycled by consumers as well. The paper in the tea bags is biodegradable and used tea leaves make as an excellent fertilizer. Piping's packaging provides consumer advice on recycling. So all of these points that are mentioned here can be seen as a competitive advantage for our business. And you can definitely use these ideas when you are writing mocks with us. Because the whole idea of doing this pre-scene in detail is to first and foremost help you understand the nature of our company. Secondly, we are giving you great ideas along the way to have material in your mind and use it when we start writing mocks. For example, whenever you are writing an answer, ending an answer, whenever you're writing anything on costs, sustainability, you can include a line saying we are doing our part by minimizing waste, minimizing packaging, and then just go on blah blah blah, write whatever you have to write, link it to the question. But by using the material in this pre-scene, by using these pointers that we are giving you, you're adding value to your answer, you're adding integrative marks to your answer, which is very, very important from this case study exam perspective. So remember, all of this information that we are giving you is for two reasons. One is to understand the company, and second is to take great ideas and then to replicate it when you are doing the when you're writing the mocks with us. That's the whole idea why so much detail and time we are giving to the pre-scene analysis. We speak about piping's management structure now. Now, this structure is also important for us to understand how this company could be working. Firstly, let's look at the top. We have Karen Ambarugu, who is the chief executive. Under her, we have Debbie Sarkar, who is the chief operating officer. Debbie deals with buying, production, quality management. So everything relating to operations, Debbie deals with, falls under Debbie's remit. Next, we have Than Pale, who is the marketing and distribution director. So obviously, advertising, account management, and customer feedback falls under his remit. Then we have Murat, who is the finance director, deals with management accounting and financial reporting. Yes. Then we have Gus Ledo, who is the human resource director, recruitment, retention, and training falls under his remit. Then we have Mule, who is the product development director, who deals with tea blends and your packaging updates. Now, if you look at this diagram, you can see that each department is very, very specific. So operations under one area, finance under one area, human resource under one area, product development under one area. So there are these different specific and specialized departments looking at their areas. So we can clearly see that each director is responsible for a specific functional area. Different functions have been created. So very evidently, we have a functional group structure. Seeing the image above, we can clearly say that a functional structure seems to be in place, where similar activities are grouped together and there is a degree of specialization. Now, generally, a functional structure is recommended for small-sized organizations who have a stable environment, who don't have many different kind of varieties in products. If you look at our company right now, we are a large organization, largest in Northlandia, oldest organization also. Plus, we have very many different varieties of products. So, a very, very clear suggestion and a question that could come up is just the concept of moving to a better group structure. Let's say moving to a divisional structure. You may start selling, or you may start diversifying into different geographies. So let's say let's have a geographical based divisional structure. One divisional structure for Northlandia, one divisional structure for Asia, for example. So that could be a suggestion that comes up, that could be an exam question that comes up because of this current structure that we have in place. So in the future, we could be asked to move to a divisional structure or a matrix structure as our organization continues to grow, continues to expand. And this is part of your E2 syllabus. Another important suggestion here is that they tell us that Piping's board also has non-executive directors, and they have listed down 5 non-executive directors with a non-executive chairman as well. Now, why would they given me this information? Now, if we look at the structure of the organization, we can see that the corporate governance code has been honored in terms of balance of the board. Equal number of executives, equal number of non-executive directors. Fine. Why are we doing this? Because for a listed organization, it has to meet certain corporate governance rules and roles. The first rule is that you should have equal number of executives, equal number of non-executives. That is met. Second rule is that you should have the CEO and the chairman should be 2 different people. That is also fulfilled by my organization. The only thing that they have not mentioned anything about is the audit community, remuneration committee, nomination committee, and risk committee. Now, these are committees that are recommended under the corporate governance code, and in this pre-scene they have not mentioned anything about these 4 committees. So because they have not mentioned anything, we can assume that they do not exist currently. So if these committees do not exist, then we look at setting them up. As accordance with the UK Corporate Governance Code, listed companies must adhere and have these committees as best practice. This is important. Corporate governance is an important suggestion and a discussion. That is why I have brought it up for you and I have explained it clearly. Now, one very important thing for us to remember over here is these directors and their jobs. Why? Because firstly, you need to know the directors of your company, because directors are the people who run a company. So if you want to know the characteristics of the company, it's also important to know what each director does, because they are making the day-to-day decisions. Secondly, knowing director names can really add a lot of value to your mocks. Remember, I told you that we are doing this detailed pre-scene analysis, so you can write a good mock answer, so you can write a good exam answer. Another aspect of writing a good answer is using director names. For example, let's say in your exam they ask you any question about marketing. So you can say, when you start your answer or when you're ending your answer, just add in a line saying, let's speak to Than Pale because he is the marketing and distribution director. He will have the knowledge and the experience needed to decide on which direction to go in. Whenever you're writing anything about marketing or distribution, you can use his name. Start your answer by it or end your answer by it. It tells the examiner that this person has gone through the pre-scene. This person has spent time on the pre-scene. This person has committed time to the pre-scene. That is why these director names are important. You're writing something about human resource, use Gusk's name. You're writing something about development of a new tea blend, write Mulay's name. Anything about finance, write Munat's name. So you can remember director names and their competencies and then use it when the time comes when you're writing an answer relating to that specific area. So directors, important to understand because they'll be taking the decisions for the company. Secondly, using their names when writing an appropriate answer can really take your integration to a different level. And that is why we say director names are important. Next set of information is that the marketing and distribution is managed as a profit center. So this area, this department is looked at as a profit center. So, like I told you, the concept of responsibility accounting or the principle of responsibility accounting seems to come into the picture here, because what is a profit center? Now, this is a business unit within an entity that has the responsibility for its revenues and its expenses. So, this marketing and distribution department is dealt with in an idea as looking at its expenses, what revenues was it able to generate. So this center is based on the responsibility accounting principle, where the managers are given full responsibility of a certain center, and then you judge it based on its profit, which means you judge its revenues against its cost and see how well that department has done. Seems like a good idea because you did a certain marketing campaign, you incurred a cost. What revenues were you able to gain because of that marketing campaign? I'll analyze that, or I will partly be able to analyze that, match them, and see the just the performance, the overall performance of my marketing and distribution department. So seems like a good decision to have this responsibility principle involved here. This is from your P2 syllabus. The other four areas are only cost centers. So remember, the other four functional areas that we speak about are cost centers. In our departmental analysis, in our different director analysis, you saw that each director had a department. Marketing and distribution is dealt with as a profit center. That's what they told us. The other four areas, which we will quickly take a look at, let me just go up and show it to you. So your other four areas, which is your operations, finance, human resource, and product development, these four are dealt with as a cost center. Now, what is a cost center? A cost center is one that only is responsible for the costs. Now, obviously, the human resource department is not going to have any revenues, right? The product development department is not going to have any revenues. They're not going to generate revenues directly. So it's good that I'm not analyzing them on something that they cannot affect, that they cannot have any control of. So I'll only assess them on the basis of costs, and that is why these are called cost centers. We speak about piping's business model now. They've given us the actual business model of piping as a diagram, but we already know what the core values of the business are, how the business works, how the business is departmented. We know that. But as a summary, they've provided us the business model here. Now, the company's business model might be viewed as follows. First, how does any company define value? So piping defines values in terms of the needs and wishes of the customers. See what they want, give them what they want by looking at their preferences, like we did for those strong teas. Remember, we saw a gap in the market, a need in the market, and we fulfilled it. It became a popular product. So true to our aim of always being a quality producer and innovative producer with customer focus. After define value, how do we create the value? We create the value, which means create our product with good quality materials, with good quality packaging, which we are always being innovative about. Next, how do we deliver this value? So piping markets its product in a clear and relevant manner to maintain my brand loyalty, to maintain my brand, to manage my brand. Piping has an efficient distribution system that ensures that its products are readily available. And then how do we make sure we sell this product and gain value from it? How do we capture value from it? So piping buys high quality materials and adds value in the manufacturing process to justify its premium selling price. Piping supports growers by paying them a realistic price. And piping controls costs through operational efficiencies in manufacturing. So, our manufacturing process is one which is very efficient. Now, all of this tells us the structure and the idea of piping running its business. Innovative, good price, paying well to your where you're sourcing your ingredients from, good packaging, brand loyalty. These are the backbones of your business, which we have spoken about before as well. And by looking at this value analysis, our P2 topics straight of value analysis, value engineering, the porter's value chain come into the picture. They can clearly give you a diagram of the porter's value chain, telling you that these are primary activities, support activities for piping. Please explain what it actually means. You'll only be able to do that if you have knowledge of what the porter's value chain is, what piping's business model is. And that is why we are spending time in this pre-scene. That is why we are going through every part of the pre-scene in details and not missing out on anything. Moving on, piping has always used good quality tea leaves in order to ensure that the customers are prepared to pay a premium price in comparison to anyone else. Piping teas are slightly more expensive than competing brands. So our price is higher than competitors to maintain our brand image. So your different pricing strategies have to be kept in mind here. Let's say you are expanding and start to sell in another geographical area. What pricing method could you follow or will you follow? For that, you'll have to know the current pricing of piping that we know is premium pricing. For that, you'll also have to know the different pricing strategies and methods that are available. That's from your P2 syllabus. Only then will you be able to suggest. So this is important to keep in mind. Next, even so, tea is relatively inexpensive beverage when compared to other drinks such as coffee, fruit infusions, cold drinks. Many tea drinkers are prepared to pay a little bit more for a brand of tea that they enjoy. If you like the taste of a particular tea, you'll always buy that. Piping has always been at the forefront of innovation. We know this, it's true to our culture. For example, it introduced tea bags to the Northlandian tea market. We were the first company to introduce something called tea bags in this market. Since then, it has introduced a number of different products, primarily through packaging. So, packaging your product differently. First, selling loose tea. From loose tea, we came to tea bags. Now, we may sell the same tea, but as a drink, ready drink. It's possible. For example, piping has redesigned its tea bags several times. So we can also look at product development or market development to keep growing. How many times will you package the same product differently? At some stage, something new needs to be done. So product development or market development that we've spoken about comes into the picture here. The current design is a complex shape of the tea bag that has been engineered to permit boiling water to flow through more effectively, and so to give consumers a better tasting drink. The company also uses a patented process. It's patented, remember, nobody can copy it. That seals the foil that contains its loose teas in bags so that they remain fresh for a longer period of time. Apart from extending the shelf life, it also improves the tea's flavor. Now, this showcases first and foremost the innovative nature and market awareness of our business from its very, very inception. And because it's patented, it becomes an intangible asset. So, your intangible asset recognition, management, or recognizing a new intangible asset, they can say we have now patented a new process. How are intangible assets recorded for? How do you treat the research cost, the development cost? How do you treat it? So this intangible asset is your IAS 38 from your F2 syllabus, something that you must revise, something that you must go through. And at every stage, we'll point out important areas and sections for you as I have mentioned. Moving on, piping pays close attention to consumer feedback. The company has a website. Now they're finally telling us that we have a website. Up until now, they were saying that our major sales channel was through supermarkets. Now they're saying that the company has a website. But let's see if this website is actually able to take orders or it's just for online presence. So they're telling us that a company has a website and consumers are encouraged to leave comments. The marketing and distribution department has a team that monitors social media, looking for comments about tea drinking in general and piping in particular. So first and foremost, the website seems to be only online presence, no real e-commerce, online ordering can be done. So major area that is being taken or has to be taken into the picture here. So, but they're telling us that we have social media accounts as well. So your digital marketing aimed at relevant channels is being looked at. Always think of new innovative marketing solutions is key for any business growth. And because we have a website, because we have social media, management of the same can derive huge competitive advantage for your business. This brings consideration of your E2 topics of app management, data management, big data, data analysis. How are you gathering all these comments? How are you gathering all this feedback? What are you doing with this feedback? And this can be further advanced if you are selling your products online, because that way you'll have your customers buying information, where they're buying from, what they're buying, how many times are they buying it, and you'll be able to serve them better. So nowhere in the pre-scene have they mentioned that we have a website where we can actually order the products from. Nowhere have they mentioned that we have an application where customers can buy their favorite teas from. Next, marketing and distribution is a group of facilitators who hold focus group meetings and tea tastings in supermarkets across Northlandia. Facilitators ask small groups of consumers to discuss their opinions about tea drinking. Participants are also asked to taste and comment on samples of teas that are made from piping and from other brands. So we are trying to encourage reverse engineering here or competitor product engineering here. Which means we are trying to look at what a competitor's product is, break it down backward to see what they're offering and how we are better than them, how we can be better than them. So consumer feedback has driven a number of changes, including the launch of new teas to meet changing preferences. For example, some consumers complained that the new foil packaging was difficult to open, and so the design was modified slightly so that it was better to use, but it also preserved the freshness of the product. So our external market analysis is quite good. Being in touch with the customer is quite good. But the digital aspect is what we can look to improve upon highly, because that's the need of a modern environment. Let's keep this in mind. After that, Piping has done some market research which indicates that the consumers believe that tea has health enhancing effects. It would be against the law for tea companies to make claims to the effect unless they conducted the same tests and trials that are applied to pharmaceutical drugs. So you cannot claim, or any disclaimer that you put in your products cannot say that you will this will be a health benefit, this will be another health benefit, if you have not run strict trials which are proven. So the known facts are that the tea has health enhancing effects, but no tea company can specifically state this is the health benefit and this much health benefit you will receive if you have not had any strong research proofs into the same. So there is nothing to stop tea companies from making general statements in their advertisement, but they cannot claim any health benefits. You can say that it will keep you fresh, it will help your sore throat, but you can't say that you can cure a sore throat with our tea. That's the difference. Legally, Piping would only be in breach if it claimed that the high antioxidant quality of its tea made consumers healthier. Stating that the tea is high in antioxidants is factually correct, and any inference by consumers that they will benefit from drinking a substance that is high in antioxidants is up to them. Customers should know what high antioxidants can do. So you can put it as part of your marketing, but you can't specifically say that this will cure a certain, a certain small illness, or it will make you healthier. That would not be very legal of you to claim, because there are no real findings or researches that you've done. So this is a risk that tea companies must try to avoid. So risk management comes into the picture, your TARA framework. Next, we have a competition statement. Now, piping's most direct competitor is Hotlo tea, also known as Hotlo. Now, Hotlo competes in piping's market space by producing good quality loose tea and tea bags, very similar to you. Hotlo follows Piping's policy of selling its products in attractive and practical packaging that reflects the quality of the tea itself. So, clear situation of brand competitors, which means it's the same product, same customers, same way of selling, just the brand is different. Your brand is Piping, this brand is Hotlo. So this is the situation that we called as brand competitors and competitor analysis. The competition is going to be key in this industry. Piping also faces competition from three other large manufacturers, which is Valuti, sells its own budget brand of low price tea. So they're competing with you on, they're not competing with you rather on quality and all of that, because their quality is going to be lower than yours, packaging lower than yours, and price is also lower than yours. Then there is Jenner Tea, manufacture own brand tea for retail chains, and Own Tea, which also manufacture own brand tea for retail chains. So, for example, a big retailer like Walmart can give a contract to Own Tea. Manufactured loose tea, give it to me. I will put it in Walmart packagings and sell it. So that also happens in the real world. Jenner Tea, Own Tea, manufacture own brand tea for retail chains. Valuti makes their own budget tea, and Hotlo is your direct competitor, your brand competitor, who does pretty much whatever you do, but it's just a different brand. So just a quick analysis has also been given as a pie chart for you. If you look at the Northlandian tea market, Piping largest producer, largest seller, also in revenue, 23% of the market is under your control. Then comes Hotlo, who is just at your footsteps, 20%. You're 23, they're 20, so your competition is going to be high in this market. Valuti is 18%. So three big producers are vying for top spot here. So competition again. Then there is Jenner Tea and Own Tea, which are 17 and 14%, and then there are other some small producers as well, which make up 8% of the market. As we spoke about in the industry analysis as well, as we spoke about in this pre-scene analysis as well, your competition analysis, understanding the competition, managing the competition, staying ahead of the competition, because the competition is going to be fierce in this market. And if you are looking to go abroad, expand abroad, start to sell in different geographies, then you must make sure that the current market is fortified, which means you have a very strong presence in the current market, which you're not going to lose in the near future. Because when you start new operations abroad, you'll obviously have to give your time there, you'll have to also focus, commit over there. So all of this needs to be taken into account when a company is growing. We're now on to a very important section, the financial analysis section. This is when we start to analyze the financials of the business. We start to look at the numbers. We start to look at, the main backbone of the business, which is the financials, the money. We are going to carefully analyze each part. We are going to carefully make sure each ratio, each number is understood, because to understand the full strength of the company, the financials are an important aspect. So our financial analysis is very unique. It's very detailed. Let's begin. So the first thing that we look at, the first statement that we will look at, is the statement of profit or loss. Now, it's very important to understand the pattern first. So the first thing we will always do is look at the absolute numbers, which means the exact absolute numbers that CIMA have given us in the pre-seen analysis. So we'll discuss the absolute numbers first, and then I will showcase to you our calculations, our percentage calculations, ratio calculations on the next page to make your study and your focus on the key areas a little bit more easier. So let's look at the absolute numbers first. Looking at revenue, if you look, the first and foremost, the figures are in millions. So everything that is mentioned is in millions. Remember that. So firstly, the revenue in 2020 was 3008. We look at the absolute numbers, keep the million on the side to avoid any confusion. So revenue was 3008, it became 3080. It went up, but by a very small percent, we can say that. So company has generated more revenue, but not significantly more. The cost of the revenue, which means the cost of the goods sold, also went up, which will obviously go up if you end up selling more, because when you want to sell more, you'll have to make more. So the cost of goods sold also went up. Gross profit increased marginally. It was 1373, it became 1376. So marginal increase in the gross profit, which tells me that the cost of the revenues or the cost of goods sold has gone up, but in a more proportion when you compare it to the revenues. That is why your gross profit difference is very, very minute. So the cost went up, it will naturally go up, but the percentage of increase was one that, even in spite of your revenue increasing by a good percentage, your gross profit only marginally increased. So we were not able to control the costs very well in this period. Maybe that can be said. Maybe we were not very efficient in our production. Next, we have admin expenses. Admin expenses have gone down. They were 268. They became 243. Okay. Selling and marketing expenses have also gone down, so less marketing in this year. Operating profit has increased, which obviously your admin expenses were less, selling and marketing expenses were less, so your operating profit showed a good increase. Good. Your finance costs from 52.5 went down to 49, which means the interest payments that you are making reduced. There can be two reasons for interest payments reducing. First being, a part of the loan that you had taken is paid back. If you paid back part of the loan, then obviously you'll have to pay less interest on the remaining loan. Secondly, your interest percentages, the interest percentage that is being charged could have been minutely gone down. That is why also your finance costs reduced. When we go to the balance sheet, we'll see exactly, has a loan been repaid? If part of the loan has been repaid, then yes, finance costs going down is viable. Your profit before tax also showed a good healthy increase. Your tax from 58 million became 75 million, so you ended up paying more tax. There is one reason for this, or rather there are two reasons for this. The first one is very evident. You made more profit, you pay more tax. It's as simple as that. Secondly, we know that a very small percentage of our sales are abroad sales in other countries. So in this particular year, 2021, we may have sold more products in a country that has a higher tax rate. Let's say we are selling in Northlandia right now, tax rate is 10%, for example. We are selling also in country Y, tax rate is 20%. But this year we sold more in country Y. So obviously your overall tax rate for the group, the overall tax paid for the group increased. That is showcased here. So tax going up has two reasons. Firstly, more profit, so more tax. Secondly, you could have sold more teas, more of your product in a country that has a higher tax rate. So with all of these numbers, what we are trying to do is analyze, is there anything unrealistic? Is there anything that drastically changed? We're trying to find reasons behind each cost going up, down, so that we understand the strength of the business. And our final profit for the year is also shown a good increase, not an exponential increase, not a very eye-opening increase, but yes, an increase is seen. So from all of this, we saw that the revenue of our company is huge. We are a very big company. And then the other aspects were discussed. Now, why did I discuss these for you? First and foremost, I have mentioned that to know your company well, to know the exact details of your company, it is vital, and I mean very, very important, to have a clear understanding of the financials. Now, a behind story or a back information that I want to now give to you is these numbers. If you try to use again as part of your answers when we go to mock writing, will be a completely new, will be a completely integrative, and will be a completely innovative approach to mock writing as well, which the examiner will notice, and he will surely award credit for the same. And I know that remembering absolute numbers is very difficult. For example, from this statement, if I ask you to remember the admin expenses 243, or if I ask you to remember operating profit 375, it's very difficult to remember, right? So what we do for our students is we create a statement of profit or loss analysis, and this analysis calculates the percentage of increase or decrease from the previous year. So there is only one number, one percentage that you are supposed to remember or can choose to remember, and then include in your answers to take answer writing to a completely different level. So for example, whenever you're writing anything on expansion, market, growth, whatever, you can start your answer by saying our revenue has gone up by 2.4%. Shows that the company is moving in the right direction, but we need to do something different to propel the company forward. But this 2.4% you are only able to include because we showcased it to you. And secondly, we are telling you that try to consciously remember some of these numbers and use them when we go to mock writing, because that is where the value is. That is why we are doing this for you. So the entire pre-seen financials has two reasons. First, to understand our company, and second is to take good ideas, is to remember some of these numbers and then replicate them in the mocks when the time comes. So we've done the calculations for you. Revenue went up by 2.4%. Cost of sales, cost of revenue went up by 4.2%. We spoke about this. Your gross profit marginally increased by 0.2% only. Admin expenses reduced by 9%. Selling expenses come down to 2.6%, come down by 2.6%. Operating profit showed a good increase, 14.7. Finance cost went down by 6%. Increase in profit before tax close to 19%. Now, if I look at all of these numbers, you will see that some of them are highlighted in red. The reason for this is that I know a human cannot remember everything. All of these numbers, remembering them is not possible. I know that. I understand that. So I've highlighted some numbers in red, which I feel you can remember. Revenue, rememberable. Profit, rememberable. Finance cost, rememberable. Profit before tax, rememberable. You can remember these, and when you've gone through the pre-seen 15 to 20 times, like we ask all our students to go through before the date of the exam, trust me, some of these numbers will already be in your mind, will already be with you, and you'll be able to use them when the time comes. But for that, you will have to invest time in going through the pre-seen, carefully going through the pre-seen, not missing out anything, because this is very important for your studies. And every single thing that I spoke about, the reasons that I was giving you, those same reasons have been put into words over here for you. So we also give you a written analysis When we were going through the absolute numbers, we were figuring out why this could have gone down, why this could have gone up. All of that has been written over here for you, so that when you are going through the pre-scene, you don't have to imagine anything, think anything. Everything is present over here. So remember, you'll only be able to recall this material if you have gone through the pre-scene at least 10 to 15 times, bare minimum, before the date of your exam. That is every other day, because only then you will know the full potential, the full nature of your company, and only then will you be able to write a well detailed, well structured answer. So keep in mind, these financials are important, and very clearly you will go through it. Pause this video right here. Go back through the explanation of the statement of financial position that I have given. See if you are comfortable. Try to think of more reasons why this could have gone up, why this could have gone down. I've given you my perspective, which is enough. But quiz yourself. Ask yourself. If you are comfortable with the numbers, then you move on step by step. After that, they have given us Piping Beverages consolidated statement of changes in equity. Now, statement of changes in equity is part of your F2 syllabus. So first and foremost, if you've gone through your F2 syllabus, you will know what a statement of changes in equity looks like. You will know why it's done, how it's made. And if you have that background knowledge, now reading this will become a whole lot more easier. So firstly, our share capital and premium stands at 500 million. Retained earnings of 629 at the end of last year, so it becomes the opening of this year. The profit for this year is added. The dividend paid out in this year was 74 million, which means out of the 251.8 million profit that you made, 74 million was paid out, and that brings you at the balance at the end of this year. Now if you look at the dividends, you will see that the company paid out dividends to the tune of about 30% of the current year profits. So in the current year, if I made 251, I'm paying out 30% as dividend. So I can say that this dividend is in a fair region. It entices more people to invest in piping. Secondly, it showcases the strength of the company because you're able to pay out 30% of the dividends. And you're also able to retain 70% of your profits. So if you're going to make any big decisions, if you're going to invest in any big decisions, you will have some money ready because you've not paid out everything. Because not everything has gone out of the company. You've retained some of it. So when the time comes and when you have to make a big decision, you may have certain amount of money that is left with you. So if you have to invest in a new packaging line, or if you have to invest in a new production line, or if you want to expand abroad, you will have some money with you because 70% has been retained in your business. So I see a good business practice here, and I see good 30% of the dividends being paid to keep the shareholders happy, to entice more people to invest in the business, and to showcase piping as a strong brand that it is. So this is the analysis we take out from here. Remember, we are giving you all of this information, so when the time comes, you are able to use it in your mock questions. And trust me, once you've gone through the pre-scene 15 times, some of these numbers will automatically be in your mind, will automatically be registered with you. And you won't have to consciously, sit there and think, where was this number? What is this about? Will I be able to use it when the time comes? Automatically, it will come to you. But for that reason, you will have to invest time in the process. You will have to invest time in making sure that you are giving yourself the best chance to remember these numbers when the time comes. And that can only be done if you have spent time with the pre-scene. There is no other magic formula here. With that, we come to the consolidated statement of financial position. We'll start with the asset side. So your property, plant and equipment in this year increased. So maybe you invested in property or you invested in a new machinery. That could be the reason. Your intangible assets also went up. Intangible assets have gone up. So as I have mentioned previously as well, your IAS on intangible assets will be important, needs to be in consideration here. Current assets, your inventory from 31.4 million became 32.8, negligible increase. Trade receivables, negligible decrease. Bank, negligible increase, again nothing huge, nothing too alarming. So that brings you to your total assets amount. Coming to the equity amount now, your share capital and share premium that they have mentioned remains the same, clearly telling us that no new equity was issued in the current year. Retained earnings have gone up, obviously because of the profit that you made. Your borrowings from 750 million became 700 million. This was evidenced in the statement of profit or loss finance costs section, because the finance costs has also gone down. We made a discussion there. This is proof that finance costs have reduced because a part of the borrowings were paid back. Your trade payables, an increase but a slight one. Tax has gone up. We made a discussion on this as well. There are two reasons for the tax that could have increased the amount of tax that we paid. We've already discussed this, and this brings us to our current liabilities, so our equity side total. Now I have also created an analysis for this part, but our analysis for this part is very, very unique. We'll first talk about the most important ratio, which is the return on capital employed, ROCE. Now the return on capital employed is the amount of money that is invested in the business and the amount of return that we are getting from that business. It's very important for investors who are looking to invest in a business that is going to be profitable, that's going to give them a return. And a strong return of 18.7%, which has increased from the last year, seems like a good place to invest your money in. So we are a strong company, a market leader, we have good ROCE. So a good sign, a comparative advantage, something that you can remember and then use when the time comes. ROCE is an important figure at 18.7. Then you have your non-current asset turnover. So the revenue divided by the non-current assets slightly went down, but every $1 invested gives you a 1.68 return in our company, a good return I would say. Current ratio from 1.93 became 1.75. Quick ratio from 1.78 became 1.61. Your return on assets from 10.4 became 11.2. So you are generating a good income from the same number of assets. This year, the asset investment has gone up a little bit, but your profit has also increased. Let me first make an analysis on the quick ratio and the current ratio that we were speaking about. And as I said, on the next page, there will always be conclusions. There will always be a reason to explain why each ratio would have gone up or down. So the entity's liquidity position is good. Current and quick ratios measure the liquidity position of the company. Ideally, a ratio over 1 indicates that the company will be able to fulfill its current obligations by selling its assets. So you will be able to fulfill your current obligations. Hence, the liquidity position is still good, even though there has been a slight decline in this current year. So liquidity position, slight decline in this year, but still in a good place. Return on assets has gone up. Receivable days pretty much remained the same. Payable days also remained the same. And then we come to a very important ratio, which is our gearing ratio. For gearing, which is measured as debt upon debt plus equity, it tells us how much equity or financial leverage is being used by the company. Because generally, the general saying is that debt is cheaper than equity. Taking a loan from outside and using outside money is cheaper than giving ownership, which is equity. But that is only to a certain extent. Right now, we see that last year it was 0.4, this year it became 0.35 because part of the loan was repaid. So we can say that gearing has gone down a highly geared company is said to be a risky company because you may not be able to meet the financial considerations of paying a fixed interest at the end of every month. So a high geared company is considered to be a risky company. Piping Beverages is using a considerable amount of leverage. The number has reduced in the current year, which is a good sign, but still the financial leverage that is being used by the company is one that we need to take account of. I want to show it to you over here. You will see that the share capital and share premium was 500. Your borrowings were 700. So your borrowings are a big part of your finance, which I will say is needed. But for our case, the gearing ratio is one that has reduced. So yes, it's coming down to a ratio that is acceptable. Right now, there are no real immediate worries or concerns that we should raise, but it's good that the company is also recognizing that debt should be part of our investment portfolio. That should be part of our financing portfolio rather. So this has been taken into account by the company. It can be said to be good on the management's part as well over here. So as we spoke about it, your borrowing is a big part of your finance. So when you take into account your full equity, which is 1307 for the year, and borrowings, which is 700 for the year, your gearing ratio comes up to about 35%, which means 35% of your company is leveraged or based on your borrowed finance. 65% of the company is one that is equity financed own. So like I said, the company seems to be in a good position in terms of its financing. I won't say it's a heavily geared or a heavily risky company. Seems to be in a good place. All of this is clearly telling me that the company is now ready to take its next step, jump off into expanding globally, because our financials seem to be stable, seem to be ones which are strong, and there is a good platform to base your growth from. So as always, after each financials, there is a conclusion which explains our reasoning as to why a certain number would have gone up or would have gone down. We've put it for you. And I explained it to you while we are doing this recording together. After that, they've given us breakdown of revenues and operating profits. They've given us some segmental analysis here. So segmental analysis is important because it showcases us where the company needs to focus more, which areas the company needs to be focusing on. Now, they have given us again the figures and financials of 2 years, 2020 and 2021. The revenue from tea bags was a whole lot more, close to 10 times more than the revenue from loose tea. So it is very, very obvious that the most profitable, most highest selling product rather for my company is tea bags. So this segmental analysis is clearly telling me that the most profitable product, most revenue generating product, sorry, let me correct myself, is tea bags. So this is an area I should be focusing upon. This is an area that I would always want to keep increasing. This is an area that I would always want to keep looking at as the most lucrative market and want to penetrate it further. Secondly, it tells us that loose tea is not a very popular product of ours. So how do I increase the loose tea sales? Is there any possibility for this? That's what we should now be thinking. So from the first segment, the revenue segment, we can see that most popular product is tea bags and loose tea is less popular. Increasing its popularity should be our goal. Next, we have the operating profit. Now the profit from tea bags is obviously going to be higher than the profit from loose tea because the revenues are huge. So that is also something to take into account. Third, we look at the revenue in terms of the sales. If you look at your Northlandian sales in this year, they were a whole bunch more than your export sales, which clearly tells us export is a very small market share for us right now. We're not focusing on it. And from our financials, it was very clear that the company is now ready to jump off. The company is now ready to expand, export into areas which are lucrative for this tea market. This is further evidenced by the numbers here that Northlandian sales are dominating. We don't want to be a local company anymore. Yes, we want to maintain Northlandia as a stronghold, but we need to look at other avenues to make sure the company is growing. And the operating profit from Northlandian sales was 364. Operating profit from exports was 11.3, very evidently following the revenues over here. Now with this segmental analysis as well, percentages come from us. If you look at the percentages, then very clearly that it will showcase to you the trend as well. In 2020, the revenue was 93 and 7%, split between tea bags and loose tea. 2021, it's become 91 and 9%. So though loose tea is a very small percentage of our total sales, it has increased from last year. So it could showcase that the trend is loose tea is gaining a little bit more popularity, but our most selling product is comfortably tea bags, which we should be focusing upon. Operating profits pretty much remained the same. If you look at the region wise revenue, your exports have gone up a little bit, but your Northlandian sales are your major share, are the only area that you are looking at as of now, because 5% in a very big company is negligible. So your Northlandian focus has been absolute, but for the company to grow, expansion is on the cards. And then the region-wise operating profits have also been given, which have remained the same. And the analysis of exactly what I spoke about is present to you over here. So when you are reading through it, you will have an analysis to go through as well. When you go through this video, the explanation is there for you. But when you are reading through the pre-scene, so that nothing goes amiss, a written analysis is also given to you. So this segmental analysis opened some eyes for us. Now we come to a very interesting material that they've given us rather, which is the annual report of Hotlo, which is our major competitor. Now earlier they used to give competitor information, competitor analysis as part of the strategic case study exam. But now they're increasingly giving it in the management case study exam as well. So we'll analyze what the competitors' financials are like as well for you. Now Hotlo is piping's most direct competitor in the Northlandian tea market. We know that. We are almost and very evidently brand competitors now. So in-depth analysis of what Hotlo does is very important for me. Both companies sell the same product, which are good quality. Some consumers drink one brand of tea and some consumers drink another brand of tea. Hotlo is based in Northlandia and is quoted on the Northlandian Stock Exchange. So it's very clearly a brand competition situation. We will look at the Hotlo's consolidated statement of profit and loss, same like the piping's consolidated statement of profit or loss. I don't want you to go too deep into what this competitor's revenue is, compare it exactly to what piping's revenue is, try to make sense of all of that. I don't want that. I have put the statement for you over here for you to go through quickly and simply. No detailed dive in like we did for piping, because my company is piping. I need to know what the competitor does, but not by going through each number of the competitor. For that reason, we have calculated first and foremost for each Hotlo's financial statement, you will have an analysis that we have calculated. So same like piping, for each statement there will be an analysis which is done over here for you. So when you are reading through it, nothing goes amiss. Same way for Hotlo's statement of changes in equity, their dividend payout ratio is coming up to approximately 62%, as was 30%, which means we are keeping more in the business rather than paying it out, so that we are ready for any opportunities, we are ready for any untoward things that come up in the environment. Hotlo on the other hand is paying out 60%. That's their strategy coming into the picture here. Same way, the consolidated statement of financial position is here, and the analysis of that has also been done for you. Nothing goes amiss. But what we will be increasingly focusing on is the comparative statements that we made for you. Like I mentioned, note this very carefully. We first went through each detail of piping beverages. After that, Hotlow's statement of profit or loss they've given us, we put it there, we gave you the analysis as well. So when you're reading it, well and good, you'll understand, you'll be able to make sense because you know the method now. Then we have the statement of profit or loss. Again, analysis made, statement of financial position, analysis made, well and good, everything understood. Next, we present a most important aspect, which is the comparative statement. This is something new and innovative that we have done. This is not present anywhere. We have done this so that the important numbers from the profit or loss put over here for piping and for Hotlo for the 2021 year. And same way, the comparative consolidated statement of financial position for 2021 is also presented after this. So we'll go to the comparative numbers side by side, clearly telling us where each company stands in this year. Now in this year, if we look at the absolute numbers, first quickly, a very quick look into the absolute numbers. So if you look at the absolute numbers, let me just scroll up. You will see that the revenue in this year for Hotlo was 2587. If I quickly scroll up to my company Piping, my revenue was 3080, which tells me that in absolute terms, our company generated more revenue than theirs. Our company is a little bit of a bigger company than theirs in terms of revenue, but when I look at the comparative figures like we have on screen right now, you will see that piping has grown at a bigger percentage or a larger percentage than us. If you look at the financial statements that are on your screen, you will see that Hotlo Group grew, the revenue grew at 4.9%. And Piping Beverages revenue grew at only 2.4%. So though our revenue is bigger than theirs, their growth rate was almost double that of mine. Their growth rate was almost double in terms of, capturing market share. So this seems like a worry for piping, right? Your competitor, your closest competitor is growing at a rate faster than yours. Something to be wary about. Your cost of sales, their cost of sales also went up, your cost of sales also went up, but their gross profit went up by 2.6%. Your gross profit is only 0.2%. So they were able to control their cost of sales as well. So maybe in this year they are performing better than me. Admin expenses decreased for both companies. Selling expenses decreased for both companies. Operating profit for piping was 14.7, but for Hotlo it came up to 24%. So they are more profitable for us as well. If you look at the operating profit than us, they are higher. They're able to control their expenses, operating expenses in a better way. Your decrease in finance costs for us was 6.67. For them, there was an increase in finance costs of 6.25, which means they might have taken a new loan on which their interest payments went up. Still, their increase in profit before tax was more than ours. Ours was 18.8. Theirs turned out to be 28.4. So if I look at these most important figures, it's clearly telling me that Hotlo is doing better than piping in this current year. So something for us to keep an eye out for. And the analysis says the same. Hotlo grew at a faster rate than piping beverages in terms of revenue, gross profit, and profit before tax. Finance cost for piping beverages group decreased, while the cost increased for Hotlo, which we saw. Both saw a decrease in selling and admin costs. Overall, in terms of profitability, piping beverages did a slightly better job, which is indicated in our operating profit and margin. I'm talking about the operating profit margin and profit after tax margins. If you look at the margins, we did a better job. But if you look at the absolute numbers, they are more than us. They are greater than us. A sign of worry. Their revenue is less than yours, but they're catching up to your margins. They're doing more revenue than you. They're doing more profit than you. Their revenue is growing higher at a higher percentage than yours. It is also interesting to note that piping beverages profit after tax is almost 50% more than the Hotlo group, but in absolute terms, but in absolute numbers. So if you look at the profit after tax of Hotlo, absolute numbers directly, turns out to be 185 for them. For us, if I try to look at the same number as I scroll up, is 251. So in absolute terms, we are doing better than them. We are a bigger company than theirs, but their margins are catching up to ours. Their growth rate is strong and positive. They are a force to be reckoned with, and they are our closest competitor. So this analysis is quite important to understand their nature, what they're looking at in the market, and how they're doing better than us. So competitor analysis and competition analysis that I spoke about is very important, which is presented to you with this consolidated but comparative profit and loss statement for the year 2021. Please go through this carefully. Same way, let's now look at the comparative statement of financial position analysis. So if you look at the ROCE, ours is better than theirs. So we are more profitable. We give better returns than Hotlo. So we are more lucrative for an investor in terms of, if somebody is looking to put their money in a company that's going to give them the returns. Non-current asset turnover is also better than theirs. Current ratio is also better than theirs. Quick ratio again is following the same suit. Our return on assets is also higher than them. Receivable and payable days are within the same, I'll say, category. And gearing is also in the same category. So we seem to be in the same category in terms of the, financials, in terms of the financial position ratios. So to analyze, the ROCE and the non-current asset turnover ratio is slightly higher in piping beverages than Hotlo, which indicates that we are using our assets in a much more efficient way than the Hotlo group. The liquidity position of ours is also better than theirs. Like I said, is our quick ratio and current ratio is higher than theirs. Piping beverages using less debt in the capital structure than the Hotlo group. This is due to the fact that Hotlo actually borrowed more money in this year and piping paid off some debt in this year. So our gearing is pretty much the same, but that has happened after Hotlo has taken more debt and piping has paid off some of the debt. The return on assets is slightly higher for piping than Hotlo group. So it's very evident that these companies will be fighting for market share. The financials say the same. Our financials are strong, but Hotlo's financials, definitely the revenue and their operating margins are increasing at a rate higher than ours. So we have to look at areas of doing better and staying ahead in this market, because they are very close by to us in terms of the market share. It's in terms of the revenue as well. They are picking up pace. And that brings us to the end of the financial analysis. Remember, the financial analysis is something that you cannot grasp in one attempt. When you're going through it once, you may feel you've understood it, but every time you go through it, you will find a new avenue to explore, a new area to look at. That will be something that you will be able to gather only if you spend time with it. There are a lot of numbers. It may be very, very difficult to remember everything. I understand that. But pick 2-3 numbers that you remember from the statement of profit or loss, 2-3 numbers from the financial position analysis, 2-3 numbers from the comparative profit or loss, comparative financial position, just 2-3 numbers from each. And then when you read the pre-scene again and again and again, these 2-3 numbers that you have highlighted will remain in your mind in a better way. So it will add more value to your entire answer writing approach when you get there. But for that, you will have to very, very carefully go through the pre-scene analysis, specifically the financials part. There is no one time going through it. At least 15 times when you go through it, you will be comfortable with the numbers. Otherwise, everything will feel like it's going off the top. And I don't want that to happen. When you are going through it for the third time or the fourth time, spend time on Hotlow's financials as well. Just look at what their profit or loss is like in absolute terms. Then look at what their statement of financial position is like. Then come to the comparative statement. Very carefully go through it. And you will see that all of it is making sense because these are numbers that we have analyzed for you from the pre-scene itself. That brings us to the news analysis section. The entire news analysis section has already been analyzed for you. It has already been summarized for you and has been put into separate subheadings and separate analysis for each in our own words has already been done for you. So you don't have to do anything extra. You don't have to look anywhere, here, there, anywhere. Every single thing is in this document. This entire 60-page pre-scene document that we have available for you covers everything that is important for this exam. You will not miss out on anything. So for this last news analysis section, I'm simply going to ask you to read through this section, the last 2-3 pages under the news analysis section that we have available for you, that we have made for you. Simply go through them. It's only 3 pages of simple wording, simple analysis in our own words that we have presented to you, which has already been broken down from the actual CIMA pre-scene so that you don't miss out on anything. You focus on the important parts of this news analysis. So nothing doing, only simply go through it, only simply read through it, because this is the last part of the pre-scene. After that entire journey, we have come to the end of the pre-scene analysis. So the pre-scene is a very, very long marathon, I would say. If you look at our pre-scene, it's about 68-69 pages and the video will come up to about 2.5 hours or so. Why are we giving you this detail? To help you understand our company to the very rock bottom. And once you have gone through this analysis at least 10 to 15 times till the date of your exam, every other day is what I would recommend. You have a solid understanding of your company, solid understanding of the material that they've given to us, which then gives us a great start to jump off and begin with mock question writing. Without good P1 knowledge, without good pre-scene knowledge, we cannot begin with mock questions. So make sure you concrete your knowledge on these and go through the pre-scene as many times as possible. Thank you. This is not a one-time thing. Please go through the pre-scene as many times as possible to let everything sink in. Thank you.